Hi, everyone. I'm Rick Bensignor. Today is Tuesday, May 24th, and welcome to this week's In the Know Trader Show. Well, the market giveth on Monday, and it has certainly taketh on Tuesday. As we record, the S&P down 86 points, taking away all of yesterday's gains and then some. The Qs are down 9.6 points at 284 or so, down 3.25%. Another nasty day. U.S. 10-year rates plummeting today, almost 14 basis points at 2.72%. Crude oil is down about 80 cents or so. Nat gas, another decent update, up 9 cents, another percent or so, adding on to huge gains that we've seen. The dollar index down about 28 pips at 101.80, and gold up $19, liking the fact that the dollar's been off the last couple of days. Let's take a look at what we have on tap for today in our trader education portion. We are going to talk about that it's just fine to sit back and observe the market. In our sector overview, we'll take a look at Consumer Discretionary, the ETF XLY that represents the SPDR ETF of that sector, and then we'll look at how that's doing versus the S&P, and then we will get through as many of these big names that make up the Consumer Discretionary S&P 500 index. I've got 20 of the biggest names listed here. We'll try to get to as many of them as possible. I tried doing this last week, and our trader education section of the show went much longer than I thought it would, so we didn't get to it. So we will get to it. All right, but first things first, to avail yourselves of products that we have from In the Know Trader for you, go to our site, inthenowtrader.com, where you can sign up for our weekly ETF Tactical Trader Report. Comes out Thursday nights, gives a very broad-based macro view of the markets, looks at interest rates, credit spreads, the S&P, often the dollar, the gold market, gives you a really good background of what's going on, and then gives you a brand new ETF to trade each week and walks you through every open ETF recommendation we have on until we close it out. Our 7-11 monthly SPDR sector ETF report comes out at the end of each month, and the goal here is to outperform the S&P 500 by being in no more than 7 of the 11 SPDR macro ETFs, in other words, XLK, XLE, XLF, etc. Those 11 XL ETFs represent the S&P 500. We will put you in no more than 7 of the 11 with the goal of avoiding the underperformers. And if you stay away from the underperformers, you will outperform. As easy as that sounds, the bulk of the street cannot do this. Historically, the numbers are ridiculously low, how many people can outperform the S&P. Here's our stats. Through May 15th, we are outperforming this year by 279 basis points. In our fiscal year, which started August 1st last summer, we're outperforming by 380 basis points. And since we started this 21 and a half months ago, August 1st of 2020, we are outperforming by 6.4%. This is not unheard of, but puts this newsletter and what we do in the top 10% of all money managers out there. And in a sense, I'm not managing your money, I'm instructing you on how to do it. So I'm giving you allocations every month. This is really simple on your part to tweak what we need to do at the start of the month. You will be way ahead of the market by subscribing to this newsletter. And July will have 2-year track record. We're actually thinking of making this much bigger product available to the entire trading universe by creating an ETF out of it. So I'm already in the works of that, because there is nothing out there that tracks the S&P, trading the S&P, that is outperforming like this. Okie doke, macro sectors, here we go. Here are those 11 S&P SPDR sectors plus the S&P itself. Year to date through last night's close, you see the S&P is down 16%. 4 to 5 of these SPDRs, well, let's even say almost 5 to 6, are very close to where the S&P is or underperforming. The big gainers, of course, the ones that are doing much better than the S&P, Materials only down 7% versus 16. Energy 52, let's call it 53% up on the year versus 16% down. Just astronomical performance in the energy sector. We have been long this since August of last summer, making for a huge positive for our returns. Staples are only down 6%. Healthcare is down almost 7%. Utilities, the only other sector up on this year. We are in all of these outperforming sectors. So that is the reason why we are outperforming. We've been able to stay away from the bulk of the lousy performance this year to come up with the numbers that we do. All right, let's talk about that it's okay to sit back and observe. And what do I mean by this? Some of you are incessant on trading all the time. And as you've probably already experienced this year, that is a very tough thing to do day in, day out, especially when you have a market that on any given day, you can see the S&P up 2-3%. You can see the NASDAQ move 4 to 5% in a single session. The moves have been incredible. And think about last Friday on option expiration day, where the market opened up very strong. The S&P was up, I don't know, 70 points or so. It broke to even and then broke down big and was down about 70 points, only to close, I think, up or down one point on the day. It is very, very difficult putting on a position and trying to stay with it given this type of volatility, because the market is making it impossible for you to think that you're right at any given time. And other than, in general, let's say, putting on short positions and staying with them, which has worked this year, there's very little you can do on a day in, day out basis to successfully trade. So it's okay to sit back and observe, especially if the market's potentially at a critical turning point. So let's take a look at, let's say, the chart of the Dow Jones, and it's a weekly chart of the diamonds, right? So this is just the ETF that tracks the Dow. So we see the sequential upside exhaustion signal right before the all-time highs are made, the breakdown since, the fact that a few weeks ago, price broke down through the cloud. But notice where we're finding support at the propulsion exhaustion level, which we caught 2 weeks ago on the low. Last week, we went beneath it and pretty much closed right on. And this week, we're still kind of hanging above. Well, if we get much more weakness, we're likely going to see a move down that's going to test at least 300. If you want to play this game, you're in a place here just simply looking at the Dow, and in our weekly tactical trader report for in the No Trader clients, we look much more closely into this in terms of the S&P and the key levels there. But let's just take a look at the Dow, because so much of the public, the individual investors out there, like to listen and think of the Dow as, you know, the benchmark. And the reality is, it is only for individual investors to benchmark. It is not for the institutional community. But your nightly news reporter is going to tell you what the Dow did, and it has basically forever. So that's what the public is accustomed to looking at. But the point is here, yeah, there's clearly some support in the diamonds right around 327. That can't be right. Where's that level? Sorry, 312.5. That's where this propulsion level is that has basically bottomed us recently. So do you buy the market and hope it moves higher? Well, you could, and at least this way you know where your stop out is on a Friday closing basis. But the way the market's moving now too, imagine, do you want to wait necessarily to a Friday close in order to determine if you should get out of new longs that you put on here? If you put on new longs here, what's your upside? Well, right now, I would say we could get to perhaps 330 to maybe as good as 338 near term. I would say between the conversion line, the baseline, and then the bottom of the cloud acting as resistance on the way up. That's about as good as you can hope on the upside. So 15 to maybe, I don't know, 22 points on the upside. And with a price here at 316, and this level at 312, the risk reward is good if you can stop yourself out properly under 312. But again, you're not going to be able to do that until Friday close. So why am I saying this? Because sometimes it pays to just watch and not actively trade and not incessantly trade, but simply watch to see what happens. We're all probably long enough in the market that if we didn't capture this exact bottom here, we'd still be okay and have plenty of exposure in the market. If you buy more here and it goes down, you're not only going to lose on what you just bought, but you're losing on the bulk of everything else that you still have, or at least giving back money, given this broad rounding top and everything going on in the world that are still macro headwinds to the market moving higher. So I kind of am in the camp that it's not a bad idea to kind of just watch right now, because it's too unclear which way this is going. There are other times and places that we can put on bets with more confidence of knowing what's going to happen, given the erratic nature of daily trading right now. And here, if I were to put this to a daily chart, and we put this on, let me see, I'm going to add a study here. Let's go put on ATH, which is the average true range. So right now, this means that the diamonds are averaging 7.1 points per day in price movement. That's a high to low of over 700 Dow points a day. Is that a market that you're sure you know how to play, want to play, and need to play? Or are you better off managing the positions that you have on and trying to reduce risk in a very risky environment as compared to trying to put new stuff on all the time? So I'm not going to answer the question for you, but I'm going to suggest that you ask yourself the question and figure out what's best for you given this type market. To me, there's definitely times and places that it just pays to be more of an observer than an active trader. That is that. So now let's get into looking at our charts of, first, we're going to take a look at the sector focus for the week, consumer discretionary. Here's the XLY chart. You can see it too is kind of trying to hang on to a propulsion full exhaustion level. My guess is we're going to still head lower, at least to 129 and change. And most likely play with this weekly TDST line over the next couple of weeks. So I don't think we've likely put in a bottom yet, but somewhere down between 138 and 129, if you are convinced we're not going lower, then that's the zone you probably want to do the buying in. The fact that not only is price action underneath the cloud's bottom, which you can see earlier this year, 3 different weeks in February and March, the lows were made right against it. We broke beneath it in late April, and it's been down since. And then the lagging line broke through its cloud, which would have been last week, was kind of the killer week. This is not in a particularly good looking mode and has given up, the bullish mode that it's in. Now, if we look back to COVID in 2020, we also broke through the cloud and the lagging line broke through the cloud, and then things nicely recovered. The question is this going to happen now? And I'm not sure, but I would say that there's a sense here that this could still trade a little bit, several percent lower. Let's look at how consumer discretionary is doing versus the S&P. And this is the total trading history of XLY versus SPY in the 24 years or so that these spider ETFs have been around. And the most important thing that I see is that recently in 2022, we've come out through the bottom of cloud support. We've broken all these recent trend lines. The lagging line has broken through the bottom of its cloud. That's not good. Notice back here in 2008 and 2009, when we were in the height of the debt crisis, the lagging line was able to hold against the bottom of its cloud, barring one monthly low. And then it turned right back around. This is an ominous sign for this sector. It's fallen apart sharply, incredibly quickly. And this would suggest that this would have a rough time making new all-time highs, and that if you got some outperformance in the consumer discretionary side in the future, later this year or into 2023, it's going to have to deal with this cloud and getting back through there before, you know, I'd be comfortable buying strength. The only way I'd probably buy this at this point is buying weakness, when I can define that we're more likely at a place that we have a true bottom. So that kind of keeps me in a defensive posture for the names that we're now going to go through in the sector, thinking that we're probably not done. So let's go to the granddaddy of them all, which is Amazon, biggest weight in here. And you can see too that, you know, price broke through the cloud earlier this year. The lagging line broke through its cloud. We'll bring in a little more data here so you get a perspective over the last several years that this has always been in bullish mode, and the cloud has always been support, and the lagging line had never broken through, and it has now. So that puts in a multi-year high. That gives us a target down here near just north of 1800 from the current 2077. We're on a 12 count towards a 13. So next week, possibly over the next few weeks, in fact, we can have a 13 and maybe even a set of 9 count as we get towards here. Opens the door for potentially buying some Amazon there. I'm not ready yet at current price to do so. Tesla coming right down to support here. So 627 is the weekly TDST line going back to the middle of last year. So we know there's some support. The cloud price action is beneath the cloud. That's bearish. The lagging line is in its cloud. That at least tempers some of the bearishness. But this is one of those ones that only if you're really bottom fishing here do you go into this kind of roughly 630 to 610 level to be a buyer. I know that there's real good support down here at 550, and you'll know. So here, last thing we do before we move to the next chart, take a look at Tesla near 550, and it's acting the same. Okay, so let me grab the exact low. Or here, we'll do this in here. So somewhere right around 550 has multiple lows, plus it was what, wait, let me think. Oh, yeah, it's not all that far from where this broke out towards the upside in the fall of 2020. So somewhere down there in and around that level is some support, plus the lagging line against the bottom of the cloud the next few months, 544 is going to be important. So maybe I'll do some nibbling there. But this one's a tough one, and more importantly is take a look at the wall above this that this is going to have to face in the future. So no new highs coming in Tesla, in my point of view, for a good long time. Home Depot. We've broken the cloud. Lagging lines broke through the cloud. We're only on a 9 count towards a 13. So that's potentially trouble too, that this is not done bottoming, and you can see what this has to face above us. McDonald's, one of the better looking charts, bottomed against the cloud, bottomed against the cloud. Yeah, we can draw a downtrend line here. This is kind of in a triangular pattern, right? Kind of looks like we've got something like this to deal with right now, and we're smack in the middle. So not much to do here, but certainly better than the other two we've looked at. Nike getting very close to the risk level from the 13 count, but it too broken through its cloud, lagging line through its cloud. No exhaustive signals yet. On the COVID low, we at least had the set of 9 count. We're not there yet here. So makes me think that you'd be very, very aggressive being a buyer here. There is a breakout point, actually. If you mentally extend this bold blue line here, yeah, that's kind of near where this broke out from. So yeah, there is some support here, but structurally this is quite weak. and it's broken. So I guess I'm not ready yet to, with my own money, to be buying Nike. And you can see too, going forward, where the cloud's going to be over the balance of this year, and kind of get a sense of what this is going to have to deal with on the upside when and if it rallies. Let's go to Starbucks. The only thing Starbucks would have kind of now is the fact that you've got a 13 signal, so it's late to be a seller. Doesn't mean it can't go lower, but from a risk reward point of view, harder to sell this here and first make money. Next week is going to most likely be a 9 count also, so you have the 13 and 9, but structurally, same type bad story here. Price is beneath its weekly cloud. The lagging line tried to hold against the cloud. That's broken too. We're beneath the full propulsion levels. This could easily get down to $60 from the current 72. You have to be a very aggressive buyer to be a buyer in here. Target, oh boy, we know what happened last week with Target, disaster. There is perhaps a little institutional bottom fishing down here. The 13 has nothing to do with the fact that the propulsion full exhaustion level is at 144. This week's low is 145 and change, almost 146. So you might find a little bit of nibblers down here, but again, structurally a disaster. You've now taken out 2 years, almost 2 years worth of buyers. So anybody who's bought this in the last 2 years is underwater. That's going to put a lot of potential future selling at hand on any rally. So the smarter move, yes, you could buy it and hope that this 13 catches the bottom. I don't like to really play with hopes. The smarter move is understanding how many people are trapped in this name. So anything back to north of, anything back to 180, 190, where it broke down from, right? We have a low here, we have a TDST line. So anything 186, 187, anything you get back there, if you're along this name, my recommendation is you get rid of it and say goodbye. What's next? Booking. BKNG. Much choppier chart, but in a sideways pattern for over a year. The lagging line is right against the bottom of its cloud here, but this has been, in the past, I look at this, and this has been above and beneath its cloud many times. So not a name I really want to play. You have no edge in playing this name. The 2022 low, if this is good, came right down to that TDST line. That's down at $1,784. That's the only thing that I say here that one could potentially lean on. But to the upside, there's nothing that I really see as a definitive place that I'm a happy seller. It's an expensive stock, just not one I likely want to be involved in. Here's TJ Maxx. So this too has recently broken underneath its cloud. Lagging line has broken underneath. It's trying to hold on here, but notice that it's running into problems against its conversion line. It did so this week. It did so last week. It's done many weeks. It cannot, in fact, it's not been able to get through it for really the bulk of the year. So that's a near-term inflection point, just about $61. That continues to be resistance. You guys all have access to cloud charts. They're on StockCharts.com and virtually every other charting package. So you can look at this type thing yourself. Let's take a look at Ford Motor Company. Just tucking beneath its TDST line here. That last week closed beneath it. This week we're beneath it again. There is potentially some support down here from next week will be a 13 most likely. The cloud's lagging line is against the top of its cloud. It could get as low as 1109 in the next coming weeks. So bottom fishers, you may want to do a little bottom fishing here, but actually I'd almost say you need to look at a monthly to see, and the monthly is not going to help much at all. Nope. So you'll see that it's not so clear on a lot of these. GM, similar picture, conversion line resistance next week, probably going to be a 13. I wouldn't get into this probably until it's 31 or in the upper 20s. Total bottom fishing, and down in here, I'm more comfortable. Now it's still probably a little too early, and we'll do one last one. Out of what's left, let's see. I'm going to pick Chipotle just simply because better chance more people are involved in this. This is a very interesting chart. I'm glad I picked it. Potential. Look, we are, depending upon how we close this week, we don't have a count to say that we're likely at a bottom. There are some lows back in here, a little lower, but I'd say that this is problematic. And if we don't recover by week's end, this is probably a name that has further to go on the downside. That's it for this week. Thanks so much for tuning in. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.